Hey, what's up, everyone? Welcome back to Teaching Thursdays. Here we are into the new year, and we want to go ahead and talk about a topic that we've talked about some of these things before, like index funds, exchange traded funds or ETFs, and mutual funds. But one thing we haven't really talked about yet is the expense ratios, and these are the costs. Now we've talked about commissions and trying to cut down on the commissions, which is basically when you buy a stock, you usually pay a price to buy that stock. Same with an option, so on and so forth. So with expense ratios, these are just fees that these different types of funds have, which these are going to be the three major funds that you're going to invest in, that they have to kind of keep things going. So if we look down here, we have WISE or even expense ratio. So an expense ratio, they have them because each fund is probably going to have a manager. They have to pay taxes. Performance of the fund is what's going to decide what the expense ratio is. Because in essence, if you think about it, if I'm a manager of a fund and I say, hey, I can get you 30% per year, I can charge you a higher fee than somebody else who might only get you 10%. It just kind of varies. Also depends on what type of investments are out there. I was reading Peter Lynch's One Up on Wall Street, and he was talking about some funds actually have limitations on what assets they can invest in, and that can decide what the expense ratio is in there depending upon what they buy. And then, of course, regulatory. So, there's the SEC, FINRA, SIPC, whatever fees they may have to pay just for continue to keep the lights on, pretty much. That's what's going to help decide an expense ratio. Now, some things to also consider with the expense ratio is what is actually in the fund. So if we're looking at, a more of a S&P 500 here in the States, large cap, your well-known companies like Verizon, Microsoft, things like that, they're probably going to have a lower expense ratio. They're relatively safe. It's not too much going on there. But then if you're looking at more of like international stocks, trying to invest overseas and out of the country, it might cost a little bit more because now you have to account for staff that's not here in the United States, or how many people are even on the team. What are the regulations going on over in those nations as well? And that's going to help decide an expense ratio. Then also, is it actively managed or passively managed? If the fund is actively managed, the manager's always in and out, making moves, they're probably going to charge you a little bit more because of all the transactions that are going on. But if it's passively managed, then there's probably not going to be as high a fee because there's not that much work going into it. Now, of course, we mentioned about the index, ETF, and mutual funds. So what are some typical expense ratios for each? Well, first up, we're going to start from lowest to highest, traditionally. And an index fund, normally you're going to be looking for an expense ratio that is less than 1%. And these are just because index funds just track indexes. You track in the Dow Jones, the NASDAQ, the S&P 500, Russell 2000, which is for small cap stocks. There's a mid cap, which is, those companies that are valued between 2 and 10 billion. We have a video on market capitalization, so you can kind of get a better idea of what that is. And so since these are, relatively safe, they're tracking an index that's kind of gradual increase, their expense ratios tend to be less. They're passively managed. It's really not much that's going on. So those are, of course, are going to be your cheapest ones. Next, we're going to have exchange traded funds. And typically an ETF expense ratio is going to be less than 2.5%. So it's just a little bit more than an index fund. But ETFs, they trade like stocks, so they tend to have a little bit more. They tend to have a little bit more volatility. Moving up and down a little bit more. So they're going to charge us a little bit more, but you definitely shouldn't be looking to pay more than that. It's just like buying any other stock, and they're relatively safe. Lastly, we're going to have mutual funds, which many people know about and have invested in the past. And of course, the shift now, everyone is kind of shifted away from the mutual fund and into the ETF and the index fund, specifically the ETF because they're easy to buy for people like you and I. So with a mutual fund, typically the mutual fund, their expense ratios are going to be probably higher than an ETF, or if not the same. So we'll say at minimum, we'll say 2.5, but they can be all the way up to even 20%. So here we go, 2.5 to 20%. Now, of course, you never know. You can find a mutual fund out there that has an expense ratio that's less than 2.5%. You can find an ETF with an expense ratio that's more than 2.5%. But these are traditionally the ranges that you're going to be looking for within each one, and kind of what you're going to have to pay. Also, as mutual funds, there are the front load fees, the back load fees. You should be looking for a no load fee mutual fund where you don't have to worry about paying just this it's just see it as just a fee that you have to pay either when you're buying the mutual fund or when you sell it off. So these are pretty much the ranges for each one. And the higher the fee, the more it's going to eat into your profit. So just think about taxes. The more money you make per year, the higher tax bracket you're in, and the more money that you can't take home. Just like with inflation, inflation is eating into your money every single year. So the higher the fee, think of it just like as taxes or inflation, it's going to continue to eat into your profits. So you want your expense ratio to be as low as possible. And that's why the shift is going from mutual funds to ETFs and index funds, mostly because they're passively managed. So there's not really much going on. And they're also safe, so you don't have to worry about too much fluctuation in the market affecting these two. And, in a nutshell, that's pretty much what expense ratios are. We have some reasons why expense ratios exist. The three typical funds that you're going to find expense ratios, as well as what are some typical expense ratio values that you should be looking out for. And remember, try to keep them as low as possible. Peace.